The committee will come to order. Good afternoon and welcome to our hearing today entitled Drivers of Discrimination, an examination of unfair premiums, practices, and policies in the auto insurance industry. And without objection, the chair is authorized to declare recess of the committee at any time. Without objection, members of the full committee not on this subcommittee are authorized to participate in today's hearing. And I will now recognize myself for 4 minutes to give an opening statement. Insurance marketing and advertising are ubiquitous. Everyone is familiar with Geico, with the Geico Camel, the Allstate Mayhem, or NFL athletes selling auto insurance via colorful and often memorable ads. What is also widespread is the use of credit-based insurance scores in the insurance industry. Most consumers are likely unaware that if they are behind on one of their bills due to injury or illness, this delinquency might negatively affect the premium that they pay for their auto insurance. And the Federal Insurance Office reported in 2017 that approximately 18.6 million Americans live in zip codes in which auto insurance is deemed unaffordable. Unaffordable. That report considered the average annual written liability premium for the 28% of American zip codes that the office deemed to be traditionally underserved communities. Auto insurance premiums, for example, are based in part on driving-related factors such as an individual's consumer's driving record. But the use of such factors can raise questions about fairness. For example, racial profiling and other policing tactics that disproportionately target lower income and minority communities could artificially increase traffic violations for certain consumers. Think of Ferguson, Missouri. In other words, not only is the police department discriminating against you, but then you're paying more for your insurance simply because you were profiled. While the two do not seem to be related, the consequences of higher insurance premiums are quite profound, because then you have less money to save in order to purchase a home, send your children to college, or invest for your family's future. In short, they serve to exacerbate the racial wealth gap. And when auto insurance premiums utilize non-driving related factors such as a consumer's credit history, homeownership status, professional occupation, and educational attainment, communities of color tend to benefit less based on the available research. The use of these factors also raises questions about fairness because it does not have an obvious correlation to losses covered in an auto insurance policy. And because these factors can sometimes serve as proxies for socioeconomic status and race, some consumer and civil rights groups have pointed out the problems going back many years, and we will soon hear testimony about these practices. Certainly, based on today's written testimony, the auto insurance industry does not intend for this result, but nonetheless, it demands action on behalf of American consumers, and the draft bill by my colleague, Congresswoman Tlaib, asks the Federal Insurance Office to study the possibility of disparate impact in auto insurance pricing. I'm hopeful that we will learn from this conversation how we can ensure reasonable pricing for all insurance consumers. And I now recognize the ranking member, Mr. Stivers, 5 minutes.
Thank you, Chairman Clay, for convening this important hearing. I can say with great confidence that everyone in this room agrees that discrimination in all its forms is abhorrent. It's also illegal. But tragically, our country has a lengthy history of redlining and other forms of discrimination in financial products. This history prompted landmark federal legislation prohibiting discrimination, like the Fair Housing Act and the Equal Credit Opportunity Act. Now, because insurance products are primarily regulated by the states, I'm grateful that we have somebody testifying on behalf of the National Association of Insurance Commissioners who will be able to speak to the history and what happened at the state as far as state laws and enforcement mechanisms designed to root out and eliminate discriminatory practices in the insurance industry. So, Mr. Chairman, I think this hearing is justified, and we should periodically examine what's going on with insurance markets and how our state-based regulatory framework is working to protect policyholders and prevent discriminatory practices. Now, whether the legislation that's been posted for this hearing is justified is another matter. Our committee has considered several bills aimed at reducing the number of factors that insurers can use to assess risk, most notably the PAID Act, sponsored by Representative Watson Coleman. That bill would restrict insurers from considering 11 different factors while setting actuarially sound rates. And I suspect that the PAID Act divided committee Democrats. Therefore, I know we're looking at a bill that our colleague from Michigan that has authored that would eliminate one factor, and that's credit scores. But despite today's hearing being focused on a narrower bill, the underlying set of questions remains. First, should policyholders' premiums reflect their underlying risks? Second, does credit reporting information help predict the risk of an individual so they can set actuarially sound rates for that individual? Lastly, do high insurance costs in Michigan, with its unique laws relating to personal injury protections, justify the federal government upending a state-based regulatory system that has successfully protected policyholders for decades? In assessing these questions, it seems to me that the underlying premise of this bill is flawed. Removing credit scores in assessment of risk will not resolve Michigan's self-imposed affordability problems. But we will need to take a step forward, and I'm excited to have this hearing to look into what's going on. I think we all want to do what we can to make sure that the system is properly underwriting the risk of individuals. And I'm glad to hear that Michigan is actually taking up its problem with personal injury protection with state-based legislation to fix that problem, because as a neighbor to the south, I can tell you, insurance rates in Ohio are much, much more affordable than they are in Michigan, and our demographics are very, very similar. So I'm glad that Michigan is taking up their own problem. Mr. Chairman, I do appreciate you calling this hearing. I really look forward to hearing from the witnesses and look forward to hearing all your testimony. I yield back, Mr. Chairman.
The gentleman from Ohio yields back. I want to now recognize the gentlewoman from New York who happens to be the chair of the full Committee on Oversight and Government Reform, Ms. Maloney of New York. 1 minute.
I thank the chairman for calling this very important hearing on the impact of discriminatory practices in the auto industry, especially on lower income and minority communities. This cannot be discounted. It's very serious. There have been studies that found on average a good driver in a predominantly African-American community will pay considerably more for state-mandated auto insurance coverage than a similarly situated driver in a predominantly white community. So this is serious discrimination. There are often objective, subjective calculations, and discriminatory practices can rob hardworking Americans of the economic mobility that they desperately need. I believe this hearing is incredibly important. There are factors that insurance companies use to calculate the premiums, like insurance scores based on credit scoring, and even the use of non-driving factors have been proven to disproportionately impact low-income and minority communities. This is a serious challenge. I'm pleased that the chairman is working on this, and I'm here to to work with you on legislation and other actions you think may be necessary. And I yield back. Thank you.
The gentlewoman from New York yields back. Today, we welcome the testimony of Douglas Heller, insurance expert, Consumer Federation of America. We also have with us Elizabeth Kelleher Dwyer, Superintendent of Insurance, the state of Rhode Island, on behalf of the National Association of Insurance Commissioners. We also have Eric Poe, CPA and Chief Operating Officer, Cure Auto Insurance, as well as being joined by Sonja Larkin-Thorne, Consumer Advocate. It says parentheses retired, but I don't believe that. And finally, we have Erin Collins, Vice President, State Affairs, National Association of Mutual Insurance Companies. The witnesses are reminded that your oral testimony will be limited to 5 minutes. Without objection, your written statement will be made part of the record. You are now recognized for 5 minutes to give oral testimony in your presentation. And know the light system we have here. You have 5 minutes. When that red light goes off, I will gavel you down. So you'll know what it means. Anyway, let's start off with Mr. Heller, 5 minutes. Turn on your mic for me. Turn on the mic.
Chairman Clay, Ranking Member Stivers, and members of the subcommittee, thank you for the opportunity to present today. I am Douglas Heller. I'm an insurance expert for Consumer Federation of America. And for reference, I'm also an appointee to the Federal Advisory Committee on Insurance and the California Automobile Assigned Risk Plan. Since the purchase of auto insurance is mandated by law in almost every state, we believe government has a special obligation to ensure that insurance is available, affordable, and priced fairly in the marketplace. However, in most states, the market for auto insurance is not fair for low and moderate income consumers and in communities of color, even if the drivers have a perfect driving record. The data I will share today comes from recent testing that CFA conducted that reviewed online premium quotes from one of the nation's largest auto insurers. Each quote represents the cost of minimum coverage policy for a 35-year-old driver with a clean record, and each is for a driver who lives at the same address, drives the same car, and has the same daily commute. The first test was for a man who is an investment banker with a graduate degree. He owns his home, and he's been insured for the past 3 years. The insurance company quoted him a premium of $718 for 6 months. I then tested the same driver, except instead of a male driver, I asked for the price for a female driver. The basic liability policy increased for her to $813, a 13% gender tax on women. If instead of having a master's degree, she has but a high school diploma, her premium jumped another 5% to $852. And when I changed her to a renter instead of a homeowner, still at the same address, her premium increased another $84 to $936 for 6 months. And then finally, if instead of an investment banker, she is a supermarket cashier, she will now pay $1,079 for the same coverage the highly educated male investment banker got for $718, even though they both have been accident and ticket-free for all 20 years they've been driving. All told, in order to comply with the law each year, this working-class woman must come up with $722 more than the socioeconomically advantaged man. Now, while no insurance companies formally base rates on income, many use these various proxies for income as tools to slice and dice and price consumers in a way that consistently leaves lower-income drivers with good records subsidizing much less expensive premiums for financially secure customers. Now, these premiums I quoted didn't include the effects of 2 other non-driving factors, credit history and current insurance status, that can account for hundreds and even thousands of dollars in surcharges. In all but 3 states, auto insurers use credit-based scores to determine premiums. And the following Consumer Reports data from Florida corresponds to what we see in most states. In Florida, a safe driver with excellent credit paid $1,409 per year on average for insurance. However, if the same driver merely had a good but not excellent credit rating, the premium jumped by $312. And the same driver with poor credit paid $3,826 for the same coverage that the excellent credit driver got for $1,409. That's a 172% rate hike for poor credit. And it means that 2/3 of the total insurance premium is attributable to their credit history, even when their driving history was impeccable. But nothing highlights the problem quite like one finding from Consumer Reports. In most states, the impact of having poor credit is greater than the impact of a drunk driving conviction. In Florida, a safe driver with a poor credit score paid $1,552 more for auto insurance. That's 68% more than a convicted drunk driver who happens to have excellent credit. Now, the last driver of discrimination is that I'll talk about is the surcharge for a break in coverage. This break could mark a period in which the customer was driving uninsured, or maybe didn't have a working vehicle, or it could even be that they did not carry coverage while they were deployed overseas. Returning to the supermarket cashier, we said that instead of having insurance for the past 3 years, we said she is not currently insured because she has not needed coverage, and her premium jumped 41%. When we tested a member of the National Guard who selected the pull-down menu option on the insurance company's website that said, "I'm not insured because I was deployed," he was charged $213 more on a 6-month policy. That's a 25% penalty for his service. And in our research, we have found evidence of this Patriot penalty in at least 21 states. Mr. Chairman, we are very grateful that you have begun assessing the unfair situation the poor face when buying state-required auto insurance due to their socioeconomic status. And as you expose this new form of redlining, it will become more and more clear that action is required to rectify these discriminatory practices. And we particularly appreciate the work of Representative Tlaib and Watson Coleman for their leadership on this issue. Thank you.
Thank you. The gentleman's time has expired. Mr. Poe, you're recognized for 5 minutes.
Thank you, Chairperson Clay and subcommittee members for having me here. My name is Eric Poe. I'm the Chief Operating Officer for Cure Auto Insurance, a direct writer, a not-for-profit auto insurer in the state of New Jersey and Pennsylvania that does not employ the use of credit scores, education, or occupation, but will be forced to adopt credit in the next year due to competitive reasons. As the original insurance whistleblower that has crusaded against this practice for the last 15 years, testifying across this country. And in particular, 12 years ago, I was before this Financial Services Committee on this issue. I have not received warm welcomes from my industry at trade luncheons, but I have won over my conscience in how we do business. And in my limited time here today, I want to quickly address 2 questions that are fundamental to this committee. And that is, why does the industry use socioeconomic rating factors, number 1. Number 2, how do they actually get this before and passed by regulators throughout the state? And then in summary, talk about what the unintended consequences are in this country when we use these socioeconomic rating factors and what would happen if we actually support the ban in the PAID Act. So starting with why, simple reasons. 2 subcategories of why the industry does this is simple. The oldest thing in America, for profit and greed. The reality is higher income drivers produce the highest profits for our industry. Therefore, any proxy that has anything to do with income will produce the same results. If you run a business and you want to make a profit, of course you're going to adopt practices that give you the biggest profits. Number 2, data mining. Unbeknownst to most people in this room, if you simply get a quote for car insurance on Geico and you never even buy a policy through Geico, in their terms and conditions, you agree to allow them to run your credit report, how often you actually make payments on your lease payments, et cetera, and they actually can share it with every marketing partner they have of Geico. So moving on to the how. And to get to the how, before I do that, I want to share with you the results of the largest study ever done regarding occupations. In this country, in the year 2000, there was a million policies studied of occupational groups outside of students. The 3 highest propensity of getting in a car accident in this country were doctors, attorneys, and architects. That flies in light of the notion that these are valid predictors of risk. So you ask yourself, how do we get these factors used in every state that we write this business in terms of the insurance industry? And that is because they've done a successful job of redefining the word risk. If you look at every single state in this country, you're not allowed to adopt factors that don't show a valid predictor of risk. What the industry has done successfully over the last 30 years is redefine what does that risk mean by using a term called loss ratio. Loss ratio is simply a measurement of profitability. For the industry, if I say that I have a loss ratio of 90%, that means I actually make 10 cents on every dollar that I collect. So what they've done is they've taken factors and they've showed studies that these factors correlate to loss ratios. Those loss ratios are simply saying that they are more profitable. So yes, any variable that ties to income is going to show loss ratios that correlate to those factors, but they are not dealing with the risk of somebody driving unsafely on the road. Now, in terms of the impact that this has on the country, we can look at the best state of New Jersey. In the year of 2003, there wasn't, for 30 years of mandated insurance in the state of New Jersey, there wasn't a single car insurance company that was allowed to use credit scores, education, or occupation at all. So we can look at that state as an isolated state. Since 2004, since they led credit scores, education, and occupation in the state of New Jersey, bringing in Geico and Progressive, two things have happened. Geico now is the largest writer of car insurance in New Jersey, collecting $1.7 billion annually in just New Jersey alone. Progressive not too far behind. But more importantly to this subcommittee, which is important, is that the uninsured motorist rate in the state of New Jersey has gone up 90% in 15 years. So you want to know what the impact is, we can look at New Jersey for what that does countrywide. Now, what would the impact be in terms of banning this countrywide? Simple. Don't let my industry convince you that this is going to make rates go up for everybody. It doesn't make any sense. We're not talking about banning the use of seatbelts and headlights and blinkers. We're talking about there's going to be an aggregate loss to the system every year in every state that insurance is written. All we're talking about is how we're going to fairly distribute what those rates are going to be for the people in this country. So there are 30 million Americans that are currently driving without insurance because they can't afford it. And it is the obligation of this country to do something about it. Thank you very much.
Gentleman's time has expired. We now go to Superintendent Dwyer, 5 minutes.
Thank you, Chairman Clay, Ranking Member Stivers, and members of the subcommittee. Thank you for the invitation to testify today. We appreciate the subcommittee's efforts to explore discrimination in automobile insurance. State insurance regulators are committed to ensuring that customers are treated fairly and have access to affordable auto insurance products. Protecting policyholders and addressing any unfair treatment of consumers is crucial to the work we do and the bedrock principle of state insurance regulation. Auto insurance underwriting and rate setting are important for both insurer solvency and consumer protection. And insurance regulators have robust authorities to address discriminatory practices in these areas. Most states review rate filings to ensure that insurance companies are using rate factors that correlate with risk of loss or expenses and are based upon supportable actuarial evidence. The more underwriting factors that are used that correlate to risk of loss, the more accurate the risk assessment and the rate. This regulatory oversight helps ensure policyholders are charged a reasonable rate and an insurer is taking the appropriate amount of risk to maintain solvency and therefore be able to pay policyholders. However, our regulatory framework recognizes that certain risk classifications, even when accurately correlated with risk, may be inconsistent with other public policies and also provides regulators with the authority to ensure that rates are not excessive, inadequate, or unfairly discriminatory. States have significant authority under their unfair trade practices statutes, which prohibit insurers from refusing to insure, refusing to continue to insure, or limiting the amount of coverage available to an individual because of race, sex, marital status, religion, or national origin. Through these authorities, insurance regulators strive to ensure that consumers are treated fairly and to maintain the critical balance between insurance solvency and product availability and affordability. To help us implement our statutory authorities, insurance regulators have tools designed to identify problematic activity through rate approval processes and market conduct regulation and examination. State regulators also recently enhanced their toolkit by collecting detailed auto insurance data. Regulators can select a region, city, or zip code and look at the coverage type, premium, and severity of losses in that area and compare it to demographic data in their states. If states see anomalies or reasons for concern, they can follow up and look at the individual company. The NAIC is also completing a public report which will show maps at zip code level for every state under the same metrics. While insurance regulators have broad authorities to address unfair treatment of consumers, we acknowledge that insurance rating and underwriting have become increasingly sophisticated with the advent of complex algorithms and the use of big data and artificial intelligence. Technological developments have the potential to improve how an insurer does business and can benefit policyholders. However, we recognize the complexity of these processes and the importance of ensuring that they comply with state insurance laws designed to protect consumers from illegal practices. To that end, insurance regulators through the NAIC are exploring insurers' use of big data for claims, marketing, underwriting, and pricing, and developing resources to help with evaluation of complex models, including developing best practices to serve as a guide for review of predictive models. In conclusion, we share your goal of preventing unfair treatment of insurance consumers and remain committed to addressing this important issue through our supervision of the insurance sector. States have the enforcement authority, data, expertise, and understanding of local market dynamics critical to auto insurance, and are in the best position to determine regulatory and legislative approaches to address discriminatory practices. For these reasons, the NAIC opposes federal legislation that would preempt state insurance regulatory authority in these crucial areas and limit a state's flexibility to regulate such practices in a manner it deems appropriate for the auto insurance market. Thank you for the opportunity to testify, and I'd be pleased to take any questions.
Superintendent Dwyer's time has expired. We now go to Ms. Larkin-Thorne for 5 minutes. You may proceed.
Thank you, Chairman Clay and Ranking Member Stivers and members of the subcommittee. Thank you for the opportunity to testify this afternoon on pending legislative proposals regarding the use of credit scoring and the underwriting of personal auto insurance, and for allowing me to share my insight and actual experience. My name is Sonja Larkin-Thorne. I have over 40 years of experience in the insurance industry, and I currently chair the Consumer Data Subcommittee of the Connecticut Department of Insurance Advisory Council on Technology. My testimony will not attempt to repeat what you already know or have heard about the use of insurance credit score in personal auto insurance underwriting, or the many studies on this topic over the last 20-plus years. My testimony focuses on the evolution of underwriting of personal auto insurance, from traditional underwriting to the use of credit score, and now to the use of big data. I hope my testimony will also highlight how the collection and analysis of these new data sources reaches every aspect of a policyholder's life, but does so with little or no regulatory oversight, and notably less oversight than is applied to credit score. I'm an insurance underwriter by training. I spent the first 10 years of my insurance career working in or managing underwriting departments. When I began my career, the manual process of collecting and analyzing underwriting data represented a significant expense that necessarily contributed to the bottom cost of policyholder premiums. More than 40 years ago, insurers began to analyze and utilize data sources that could reduce underwriting cost while continuing to accurately reflect the likelihood and expense of a policyholder's filing an auto insurance claim. I recall training my underwriting team on how to read a credit report while they also reviewed traditional motor vehicle records and the policyholder's paper application for insurance. We had no desktop computers or electronic submissions of applications back then. Each piece of data was assigned a code for input into the company computers. Little did we know that that was the beginning of big data. There is no escaping that data is the foundation of the insurance industry, and that the insurance industry has always collected data and made long-term predictions regarding pricing, loss trends, and profitability. However, just like the days of traditional underwriting gave way to underwriting that included the use of insurance score, the heydays of insurance credit scores are on their way out. The continued difficulties of explaining the correlations between how one pays their bills and the likelihood and expense of a policyholder filing an auto insurance claim has caused the largest insurers to move beyond insurance credit scores and to look and use other data to enhance their underwriting and pricing. For example, California, and I grew up in California and lived in California most of my life, one of the largest personal auto insurance markets in the country, does not allow the use of insurance credit score. Yet the state remains one of the most competitive personal auto insurance markets in the country. This means insurance companies in California and elsewhere have figured out how to price personal auto insurance without using credit scores. The use of credit scores in personal auto insurance underwriting increasingly is being enhanced or replaced with incredible amounts of new types of alternative unregulated personal individual data, commonly referred to as big data. These extremely large data sets can be analyzed to reveal patterns, trends, and associations related to human behavior, interaction, shopping habits, driving patterns, demographics like race, occupation, and education, marital status, voting history, etc. It is this big data, often produced by unregulated algorithms, that insurance companies use in insurance department rate filings, to which I wish to draw the subcommittee's attention. Any legislative or regulatory solution that seeks to achieve the goals behind the legislation before the subcommittee today need look further than somewhat outdated and narrow issue of credit score. To this end, I'd like to draw the subcommittee's attention to the current work of the National Association of Insurance Commissioners. The NAIC recognizes and has drawn appropriate attention to the use of credit scores and to the use of big data. Currently, there are 3 working groups looking at this issue, and each working group incorporates the nation's 56 insurance regulators. My recommendations regarding the legislative proposals pending before the subcommittee are informed by my firm belief that insurance consumer protection is best served at the state level. Absolutely, there is a role for the subcommittee and for the Federal Insurance Office to work with our state insurance regulators to make sure that credit score, big data, and any other data sets used is fairly and responsibly set to set personalized insurance rates. I caution the subcommittee against imposing a federal solution to address an issue for which the state insurance regulatory system is best designed.
The gentlewoman's time has expired.
Good afternoon,
Ms.
Chairman.
Collins is recognized for 5 minutes.
Good afternoon, Chairman Clay, Ranking Member Stivers, members of the subcommittee. Thank you for the opportunity to testify here today. My name is Erin Collins. I'm the Vice President of State Affairs for the National Association of Mutual Insurance Companies. NAMIC membership includes more than 1,400 regional and local mutual insurance companies on main streets across America, as well as many of the country's largest national insurers, who collectively write about half of the nation's auto insurance business. NAMIC is here today to speak in strong opposition to legislation designed to institute broad prohibitions on the use of legitimate and predictive underwriting tools in auto insurance. It's our view that federal legislation in this area is unwarranted and unnecessary, and it has been demonstrated time and time again that such underwriting restrictions harm policyholders by driving up insurance costs across the board. I want to begin with an overview of insurance underwriting and risk-based pricing. The goal of insurance underwriting is to correlate the prices for insurance policies as closely as possible to the likely cost of claims generated by those policies. The more accurately a company targets the actual costs, the better they are able to serve their policyholders, which in turn enables them to offer more products to more individuals. Simply put, accurate underwriting enables more coverage for more consumers. Utilizing predictive information is unavoidably central to this process. Insurance differs from most other products because the actual cost of providing insurance is unknown at the time the product is offered, and the customary laws of supply and demand do not apply. Looking back at historic losses helps to forecast future losses, but prior claims alone do not provide enough information to serve as an adequate predictor of future risk. Therefore, to most accurately make these predictions, various factors are used to analyze the risk of future losses from any given policy. In today's auto insurance market, a multitude of risk-predicting factors may be considered, including things like driving history, multi-policy discounts, vehicle information, vehicle safety equipment, age, credit history, miles driven, etc. How or even whether particular factors are used differs by insurer. However, today's actuarial science indicates that the most accurate risk assessment is achieved through a combination of risk factors. It's important to note that these factors are actuarially based tools that are correlative and do not and generally cannot demonstrate causational relationships. A causational relationship would indicate that a given factor results in a loss. Even a fact pattern of a dozen prior speeding tickets and prior accidents does not result in a future loss. Any assertion that factors should be held to a causational standard fundamentally misunderstands the methodology of actuarial science and would exclude practically every exercise to try to assess risk. The U.S. auto insurance market is one of the most competitive of any industry in our economy, and competition ensures that insurers have every incentive to accurately and appropriately match the rate to the actual risk that is posed by a driver. Those companies that predict claim costs better than their competitors are typically more successful. Ultimately, we believe that competitive markets are the most effective way to ensure lower prices, widespread availability of insurance products, superior service, and product innovation. The state-based system of insurance regulation has allowed that competitive market in the U.S. to flourish. This robust regulatory system is designed with consumer protection foremost in mind and regulates virtually every aspect of the insurance business. Under state law, insurers are prohibited from setting rates that are excessive, inadequate, or unfairly discriminatory against any individual. Stringent anti-discrimination prohibitions are also in place in the states, and rating factors must be actuarially sound in order to be used by law. There is no data to indicate that these provisions or their enforcement have been inadequate or lacking. As I close, I'd reiterate that banning the use of underwriting factors would simply disrupt and substantially weaken auto insurance markets across the country, undermine the state-based system of insurance regulation that serves the U.S. well, and ultimately harm the very consumers such action purports to help. Therefore, NAMIC respectfully encourages the subcommittee to reject the legislative proposals being discussed here today. Again, thank you for the opportunity to speak here today, and I look forward to answering any questions you may have.
The witnesses' time has expired. I want to thank all of the witnesses for your testimony today, and now we will begin the 5-minute questioning period. I'll start off by recognizing myself, starting with Mr. Poe. You have testified previously that your company has chosen not to use certain non-driving related factors, such as credit history, despite the competitive advantage of doing so because of concerns about the fairness of using such factors. Can you talk about which factors your company deliberately chooses not to use, and how you believe that these company practices make auto insurance premiums more equitable and affordable for consumers?
Yes, thank you, Chairman. We don't use any non-driving factors that are what we think are obvious corollaries to socioeconomic proxies. So we don't use, right now, we examine all filings by other carriers, and I can tell you as a matter of fact that my industry uses full-time employment as a decision of whether or not you're eligible for the preferred rates of a car insurer. So if you simply lose your job, your rates will be more, and you will not be eligible for a preferred company. What my industry does is they tend to actually file 2 separate companies with the same trademark name. For example, Geico has 3 trademark name companies in almost every state they do business in. Geico, Geico Indemnity, Geico Casualty. But you only get told to go to geico.com and fill out a quote because you might save 15%. The reality is that most people who go to Geico and put in their information have no idea that on the basis of your educational attainment and your job, whether you're not in a high-paying job, you will be rejected from the preferred companies of Geico and be only eligible for a higher rate for car insurance and not be notified, because there is no federal requirement, there's no state requirement to say that you were rejected on the basis of your educational attainment and your occupation. So there's other statuses like home ownership status. There's a reason why all these advertisements talk about bundle, bundle, bundle. Does a poor person have a house? A poor person barely has a window or a pot to pee in to throw it out of. So mandating insurance becomes a public policy requirement. You guys, in terms of this committee, there's a requirement, in our opinion, that there's an obligation for legislators to make sure that if you're going to mandate car insurance, that you can't just let poor people pay more than rich people. That's the bottom line.
So in other words, you're telling me there is an extra tax for being poor.
Exactly.
Imposed on these people by the industry.
Yes, and unlike the traditional methods of predatory lending, where you can actually draw a conclusion of a credit risk because somebody doesn't earn as much money and they're more likely going to default on their loan because they don't have assets to collateralize. Here we're talking about mandating car insurance, and I can be a safe driver my entire life, but simply because I'm poor, I'm going to pay 40% more for car insurance for no reason whatsoever, except for that I drive less profits than the wealthier people in this country.
Thank you for your response. And this next question is for Mr. Heller and Ms. Larkin-Thorne. The insurance industry has been stated that it's regulated at the state level, unlike most other large industries. Mr. Heller and Ms. Larkin-Thorne, if the insurance companies don't change the way they treat certain discrete and insular minorities with regard to premium pricing, are the individual states capable of mandating change? We'll start with you.
Thank you, Mr. Chairman. Yes, they are. California is a prime example of a state that took control of insurance rating factors. The people, the voters of California changed that law. And I say that any state voters that want to build the type of coalition that was built in California, that took on insurance companies spending millions of dollars against their initiative, they can win. I believe in the power of the vote. I believe in the power of the people. And I think if they want to change, they can. And every member who thinks that there is a problem in their state should be talking to their insurance commissioners. They should be talking to their legislatures. And I think that they can facilitate the type of change they want. You look at California, you look at Hawaii, they did it.
Mr. Heller, are the states capable of mandating change?
Mr. Chairman, unfortunately, I think many states have fallen down and failed on this issue. I agree with Ms. Larkin-Thorne. I'm a Californian, and I work very closely with the California regulators. The people of California did speak. Unfortunately, most states don't have a ballot initiative the way California did to enact that law and overcome the resistance. Unfortunately, regulators around the country have fallen flat on this issue, and we need the support from the federal government to say you need to at least have a bare minimum, because if you're going to make people buy insurance, we're going to make sure that you have a floor of protections for consumers so low-income consumers and communities of color have access to products in their state.
Thank you for your response. My time has expired. The gentleman from Ohio, Mr. Stivers, is recognized for 5 minutes.
Thank you. Thanks, Mr. Chairman, for holding this hearing. Thank you for all of you for your testimony. And I'd like to start with Ms. Dwyer. Can state insurance regulators be trusted to prevent discrimination in the auto insurance markets?
Yes, we can.
What mechanisms do they currently employ to prevent this?
So we currently, in every state except Illinois, review all rate filings from all auto insurance companies. We look at them both at the form and the rates being charged. We look at their algorithms, and we test for factors such as suspect classifications. We would never allow anyone to rate on race, national origin, or religion. And that's pretty much, that is standard in all 50 states.
Great. Question for Mr. Heller. Given that you said that our state insurance regulators have fallen down on the job, they've been on that job for 75 years since D-Day, would you prefer then a federal regulator for insurance?
No.
But you'd
Ranking
prefer
Member Stivers, I actually
federal
do-
laws to override McCarran-Ferguson?
So I think that it might be good to get rid of the antitrust exemption that the insurance industry has given through McCarran-Ferguson. It's true, but Ranking Member Stivers, I actually believe in state regulation. I think it is the way to go because I do think that at the local level we can do a better job. But what I have seen in too many states is a
I only have 5 minutes, so be quick.
is a failure to protect the most vulnerable consumers. And I think efforts here in the in Congress to support a basic floor of rules and protections would be valuable.
All right. For Ms. Dwyer and Ms. Collins, does anything in this bill by the Congresswoman from Michigan, Ms. Tlaib, change the insurance rates in Michigan suddenly if this bill were to pass? Would it change insurance rates in Michigan for automobile drivers, any of them?
Thank you. I don't think it
A
would
study,
demonstrably...
would that change insurance rates for anybody?
It would not demonstrably improve insurance rates, no. I'm sensitive to the concerns of the Michigan insurance market. I've spent a large part of my career working on those issues, and they are not problematic based on underwriting factors. They are built upon the problems of the no-fault system with unlimited lifetime medical benefits.
Ms.
And
Dwyer, are
that's
you
where
familiar with what's going on in Michigan with regard to personal injury protection and what the Michigan legislature and the governor are doing to actually try to fix that to make insurance more affordable in Michigan?
Yes, and I'm absolutely not an expert, but it is my understanding that there have been changes that will go into effect in July that should be beneficial. As far as your original question, what it would do, removing one factor would reallocate. So some people would get increases, some people would get decreases. So it would be disruptive to the market, but it wouldn't appreciably lower what everyone is paying.
And Ms. Collins, let's say for a second we were to only go to driving factors. Are you familiar with the study from Stanford University that indicates that minorities are much more likely to be pulled over and ticketed than white drivers? And if Congress would decide to preempt state laws and only move to driving factors, excluding all non-driving factors, what would that do to minority policyholders?
I'm not specifically familiar with that study. Generally speaking, in terms of driving records, I do know that they are notoriously inaccurate. And I think that we have shown that the majority of drivers in America are benefited from a full picture of risk, benefited by as many factors as can be contemplated.
Is it possible that if we move to only driving factors, that potential institutional racism that happens in some places where minority drivers are more likely to be pulled over and ticketed would actually result in higher insurance rates for minority drivers?
Based on your description of that study, yes, that does seem logical.
That's a study from Stanford University. So, I will summarize it for you. But, and question is for Superintendent Dwyer. Do you think the bills attached to this hearing raise any concerns about broad federal overreach into our state-based system?
Yes, I do. And the other factor that has to be taken into account is financial solvency. So the more rating factors that are used, the better predictor of risk, the more solvent the company is. And why is that important? Because they pay consumers. The worst thing out there would be paying premium and not having your claim paid.
Great. Real quickly, just by raise of hands, is there anyone on the panel that does not support the state-based regulation for insurance under McCarran-Ferguson? I will note the absence of a raised hand, which means everyone on the panel does support McCarran-Ferguson and the state-based policy. Is that correct? Can you show me by a nod of heads or something? Great. Mr. Chairman, my time is almost expired. I would like to submit for the record letters from the Insurance Information Institute, the American Property Casualty Insurance Association, and the U.S. Chamber of Commerce that all do have some concerns about the draft legislation we're talking about today, and I appreciate them being entered into the record. I yield back the balance of my time. Thank you to the
Gentleman
witnesses.
yields back, and without objection, the documents are submitted for the record. And I have to note that my friend from Ohio has adopted Mr. Green of Texas tactic as far as a show of hands.
It's a good tactic.
At this time, we will recognize the gentlewoman from Michigan, Ms. Tlaib, for 5 minutes.
Hello, everyone. Thank you so much for being here. This is one of the most critical issues, I think, right now in the state of Michigan that is keeping people in poverty because of these high rates. And we can talk a lot about some of the other broken systems, but one question I have to follow up on my colleague's question, how many of you on the panel support proxies that discriminate? Okay. Ms. Collins, I have some questions for you. What is your marital status?
Thank you, Congresswoman. I am married.
Yeah, credit score?
I do have a credit score.
Do you know what it is?
Not offhand, no, I don't.
Okay. How about your education level?
I have a master's degree.
Yep. How about your zip code, if you'd like to provide that?
I have a zip code. I prefer not to share it.
Sure. These are the questions that are asked from my residents. They have nothing to do with whether or not they're a good driver. It has nothing to do with whether or not they are susceptible to accidents or any of these are proxies to discriminate. And it's very frustrating for my residents from their credit score to their education level to even be asked that, or them even from turning from married to widow, that they see a 300% hike in their auto insurance rates. And so, one question to Mr. Heller, one of the studies that Poverty Solutions at University of Michigan did was they looked at someone with a decent credit score and someone with a better credit score, and the person that had a lower credit score was paying 300% than the other person. But the other person, the one with the better credit score, had a DUI, drinking under the influence violation. What would justify, and again, this is a study by the University of Michigan showing a 300% hike, again, of the person that is the safer driver versus the one who would drink and drive.
Thank you, Representative Tlaib. Unfortunately, that's not just the problem in Michigan. That we see in most states. Consumer Reports recently a couple years ago reported that in most states, the drunk driver with excellent credit pays less for insurance on average for the same product than the poor credit, excellent driver. And what the insurance industry sees in the poor credit, excellent driver is somebody who, with other factors like their job title or their education, is likely to buy a basic limits auto insurance policy, and that's just not that attractive. There's not a big lifetime value to selling insurance to somebody who's only buying the minimum limits. But that person with a drunk driver, an excellent credit score, and perhaps also the investment banker with a college degree, they might buy home insurance as well, and maybe a life insurance, an umbrella policy. Maybe they'll insure their boat. The lifetime value is what the insurance companies are looking for, and that may be fine for other products. But in virtually every state in the country, auto insurance is required by law, and that's why we believe we have to have some public policy standards that say some factors are not acceptable because they're keeping people from getting into the market and leaving them uninsured.
And one of the things I want to refer to, Ms. Collins, and I would like the chairman to submit for the record ProPublica and Consumer Reports, which found that members of the National Association of Mutual Insurance Companies were charging higher rates in zip codes where most residents are minorities than zip codes that are predominantly white neighborhoods with similar accident costs. Hopefully without objection. Thank you. Ms. Collins, justifying racial disparities by pointing to differences in risk is an argument that falls apart when we really investigate the data. Why would the association be against a study just to investigate the data regarding disparate impact of auto insurance rates?
So
why don't you want to know if it impacts your consumers, the ones who are paying into the system, to make sure they're not being discriminated against?
NAMIC is supportive of objective studies that look at all underwriting and rating
So you're okay with
factors,
the federal
including-
government?
We are okay with the FTC study. There are numerous studies that look at these factors. Arkansas, for example.
Are you okay with the Federal Insurance Office to investigate? Why wouldn't they be objective?
If you're speaking to the measure in this committee, you noted that I said objective study. I believe that studies should not be built with conclusions in mind, and the language of that particular bill seems not to meet that test, so we would oppose that measure.
One of the things in some of the comments by some of your members has been, well, low-income Americans spend more money on cigarettes and alcohol beverages. Do you remember that study and those comments coming from your association?
I'm assuming
No,
you're
it's-
referring.
Yep.
You're referring to the letter you referenced in the last hearing.
That's right. I know
I'm glad you brought that up because there was an article that grossly mischaracterized a letter that we wrote directly in response to the FIO study specific questions.
But why not, Ms. Collins, support actually investigating whether or not there's disparate impacts in your industry?
We were responsive to the FIO
Support
study
it.
specific
Support
questions.
the Federal Insurance Office to provide this data and information so we
the
make sure that
gentlewoman-
our folks are not being discriminated
The
against.
gentlewoman from Michigan's time has expired. Would you care to answer, or have you answered? Or?
Yes, thank you, Chairman. I'd be happy to schedule some time to further sit down with the Congresswoman and go through those issues at her leisure.
Okay, at this time, we will recognize the gentleman from Florida, Mr. Posey, 5 minutes.
Thank you, Mr. Chairman. It's been my observation over the years that the government closest to the people works best. One of the biggest problems I observed in the Florida legislature was members of the legislature who had not served in local government thought when they got elected to the legislature that meant they were the boss of local government. And at the same time, they hated the federal mandates that would get passed down from time to time. Hypocritically, I might add, one day, actually at 10 o'clock in the morning, they passed a joint resolution of Congress that do not send us one more of your unfunded mandates, period, end of subject, exclamation point. 2 o'clock, 4 hours later, they passed an unfunded mandate on local governments. And then one of the problems I see here in Washington is members that hadn't served in local government and the state government seem to think that suddenly they're the boss of the state governments and the local governments, which makes it even worse, And on the regulatory side, we have talented leadership in our states and their insurance commissioners, and historically, states regulated insurance and help tailor insurance products to the needs of the people in their states. Today, we have legislation before us that would intervene or interfere in the state-led insurance sector by dictating coverage and premium-making practice. This would prohibit the use of credit score, credit report, or zip codes, as mentioned earlier, as if somebody in Manhattan should pay the same price for liability insurance as somebody in rural Wyoming. I don't know how you could think that, but obviously there shouldn't be any discrimination whatsoever in the insurance industry or any other industries. And to follow up with Ms. Collins, what's the evidence regarding discrimination in coverage decisions and pricing of auto insurance?
Thank you, Congressman. There is no evidence that I'm aware of that there is any unfair discrimination in underwriting or rating in auto insurance. In fact, the state-based system is quite adept at regulating the market. Superintendent Dwyer and her colleagues are robust regulators that ensure that there are no unfair discriminatory practices in the auto insurance market or any insurance market for that matter. And you'll find a no greater advocate of the state-based system than NAMIC.
Is there a case you're aware of that auto insurers discriminate based on race or gender?
No, I'm not aware of, again, any unfair discrimination in auto insurance.
How would the industry assess this bill to prohibit the use of a credit report, zip code, credit score, other consumer data or information?
Well, I think credit-based insurance scores have been the subject of quite a lot of study over the years, and they have a variety of authors, state, locality, departments of insurance, and they all reach the same conclusion, and that is credit-based insurance scores are highly predictive of risk. And I should note that credit-based insurance scores are not the same thing as a credit report. So where a credit report refers to delinquency, a credit-based insurance score aims to predict an insurance loss. And what the studies have shown is that it is incredibly predictive in doing that. So to remove that asset and tool in matching rate to risk, it would demonstrably harm the insurance market and ultimately consumers.
Many economists have written on the power of market competition to drive out discrimination. It makes sense that an auto insurance company would find little profit in deciding to charge a higher price to persons of color or women, or not to sell them insurance if a competitor would provide the coverage or could bid the business in a way with a lower rate. Can you please share with me what we know about the power of competition in discouraging discrimination, and let's just say in auto insurance, for example?
Sure. So, the state-based system in the United States has fostered the most competitive and powerful insurance market in the world, and that only helps consumers. It provides more coverage opportunities, more products, more innovation, and that only creates more space and more entities to compete for those policyholders' business. And to that end, it would ultimately be a factor that would eliminate that kind of bias rather than increase it.
Thank you. I've read that regulators in California are thinking of prohibiting discounts to certain classes of drivers because they believe such discounts are not based on the likelihood of lower claims and that such discounts result in discrimination. While this does not sound like a good policy, it is also a powerful example that states already have the responsibility to regulate their own insurance markets, making the kind of federal legislation we are examining here inappropriate and preempting this strong state-based system of insurance regulation. Can you please comment on this and whether California's plan to prohibit certain discounts is a good way to fight discrimination?
I don't believe that an initiative like that would at all address the concerns that it purports to protect. In fact, I think it would hurt the consumers ultimately because it would restrict further the ability of insurance companies to accurately rate risk and offer their customers discounts that they find valuable.
Gentleman's turn.
Thank you, Mr. Chairman, for your time.
And now we go to the gentleman from Florida. Mr. Lawson is recognized for 5 minutes.
Thank you, Mr. Chair, and welcome to the committee. And this question here, more of an observation, I think anyone can answer it. The National Highway Safety Traffic Safety Administration confirmed that male drivers cause 6.1 million accidents annually, while women at fault was only 4.4 crashes per year. Yeah, women are more likely to pay higher rates than male counterparts, according to the research just completed by the CFA. The CFA found that Progressive charged 40-year-old female drivers living in Tampa 32% more for the same coverage than male. The insurance company use of gender as a rating factor does not seem to reveal much in the way of a consistent risk assessment. Do you think regulators should reconsider allowing companies to continue using it at all? I'll start with you, Mr. Heller.
Thank you. Thank you, sir. The use of gender in auto insurance is something that surprises people, particularly women who think that they're going to get a better deal. You cited some statistics. And while it's true that in some companies young men still pay more than young women, not only has Consumer Federation of America found, but several insurance industry research and in the California Department of Insurance have found that women pay more for auto insurance now. And it's just striking to people, it's also unfair. That's why about 7 states have prohibited the use of gender, California most recently. And I think that the point, perhaps, is that we need to protect people who have to buy this product. And if the states aren't taking on that role, then it's important for the federal government to push them in that direction. And that's why this hearing is so important, if only to raise the attention and make the state regulators pay attention. We appreciate it as we're working in the states for this protection, because women should not pay more for auto insurance, and it's happening across the country.
Right, Ms. Poe, do you want to comment on it?
Yes, just that we don't use any of our genders for female.
I can hardly hear you.
I'm
Turn on
sorry.
your mic.
Just that we have never actually charged females more than males. So that data only suggests that, once again, males probably make a higher income. So higher incomes generate better profitability, and that's probably what justifies their algorithms, not based on our non-driving factors traditionally. So there's never a female that actually pays a higher rate with our carrier.
Anyone else want to comment? Yeah.
Thank you.
Dwyer.
When we look at an algorithm, when we look at a rate filing, we make sure that every factor being used is supported actuarially. So some of the information that you're producing should be taken into account by the actuary, but we do not allow them to simply use a factor that has no actuarial basis. Different companies are also going to use different factors. So as an individual, if you receive a poor rate from one company, you can shop that rate and get different amounts because they're looking at their overall risk. That competition benefits the individual consumer.
Ms. Larkin.
As a divorced mom who raised a child, when I went from married to single or divorced, my insurance rate did not change. It was the same. And so I look at it, and I have friends who have had the same circumstances, and I've not heard that complaint. And I talk to a lot of people about their insurance. Now, I live in Connecticut, and it may be the rates in our state, but I was in California at the time I was divorced, and my rate absolutely did not change at all.
Ms. Collins.
Thank you, Congressman. I would echo the comments from Superintendent Dwyer that it is important to recognize that each factor must be actuarially sound in order to be utilized. I would also note that, as I stated in the beginning, we find that actuarial science most often dictates, and that companies now employ, that it's a combination of all factors. So there is not an instance where there's an individual factor that dictates the rate or underwriting of an individual.
So basically what you're saying, I know my time is running out, in Florida, for example, an area like in Tampa where females age 40 years old are paying a 30% higher rate than they are than the males in Florida. Mr. Heller, I don't understand how that happens.
Well, it happens, and it does happen, and it happens because the insurance companies are pricing the way they want for their profitability, and unfortunately, regulators are not diving in as deep as they can. With respect to Superintendent Dwyer, I see this around the country, and I will note that the big irony here is that some companies do charge women less than men, and if the actuarial science was accurate, there's no reason that one company would see women as more risky and men as and another company would see men as more risky. They're doing this for their own marketing purposes, but consumers have to buy the product irrespective of their gender.
Okay, thank you. My time running out. I yield back, Mr. Chairman.
The gentleman's time has expired. The gentleman from Colorado, Mr. Tipton, is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank the panel for taking the time to be able to be here. Wanted to be able to get a little bit of clarity on some of the comments that I've heard in regards to a zip code having an impact on assessing driving risk. Ms. Collins, does the zip code impact what kind of a rate you're going to be paying?
Thank you, Congressman. So territorial rating, especially in dealing with auto insurance and other areas of insurance, is important in that it helps to identify areas of risk. So, by example, a risk associated with auto insurance is density. So, the number of drivers on the road, the population on the road, all factors into the risk of severity of accidents and frequency of accidents. So a car located in a rural plain state is not going to have the same risk profile as a vehicle in a downtown metropolitan area. So yes, to answer your question, it is an important factor.
So probably live in a rural area in Colorado, going to have a lower rate than somebody driving in Washington, D.C.
So I think that to the extent that the factor is utilized on territory, yes, that situation, that factor would show a lower risk.
Good. Did want to follow up with you a little bit as well in regards to the credit scoring. And you noted it's not the credit score, but being able to use it as a predictive model. Can you expand on that a little bit?
Sure. So a credit-based insurance score is a score that uses pieces of a credit report to develop an overall insurance score that relates and directly relates to the risk of insurance loss. And the studies that have been done on credit-based insurance scores overwhelmingly show that it's not just predictive, it is overwhelmingly predictive and one of the most predictive factors of insurance loss that exist.
So the credit information, as you describe it, applied correctly, can actually benefit the consumers by lowering some rates?
Yes, actually, the Arkansas study on credit-based insurance scores showed that the vast majority of drivers benefited from the use of credit-based insurance scores.
Good. Thank you. And you'd also spoke to the study bill that's being discussed here to a degree today. But studying some of the underwriting factors nationally, this would make it public information. Is that accurate?
That's my understanding, yes.
Okay. That'd be an unprecedented step for the federal government, wouldn't it?
To my knowledge, yes.
So following that line of thought, what would be the impact of disclosing this proprietary underwriting information beyond the insurance market as a whole?
In my opinion, it would create, at minimum, a dampening effect, but realistically, potentially the end of innovation in auto insurance. It would create a situation in which insurers are not able to develop new ways of assessing risk or ways to develop value propositions to their customers or to their potential customers. So I think it would demonstrably harm the market.
So just saying, why have a problem with the study bill? Effectively, this study bill would have a dampening effect and would probably impact nationwide some of the innovation that's needed in the insurance market?
I think it would be wildly detrimental to innovation, yes.
Great. We do have a well-established federal statutory precedent in this country in regards to regulation matters relating to insurance belonging to the individual states. And our states have had the authority, as the superintendent had noted, to be able to develop the insurance market within their borders. We just passed in our views and estimates out of the hearing this last week a proposal regarding some of the state impacts that we're going to be seeing, at least on the Republican side, to be able to have it at the state level. So, Ms. Collins, would a study bill before the committee today jeopardize state-based approach to regulation?
Yes, I do believe it would. It certainly does not take into account the 10,000 regulators across the United States that have created and maintained such a powerful insurance market in the states, and I think it would demonstrably undermine the state-based system and how well they regulate the market now.
Thanks. And finally, Superintendent Dwyer, almost every state in the country has adopted a law requiring insurance premiums not to be excessive, inadequate, or unfairly discriminatory. Could the public disclosure of proprietary underwriting standards undermine the foundation of fairness that individual states have implemented?
Yes, it could. Normally, those types of factors are not public.
Great. Thank you. My time's expired, Mr.
The
Chairman.
gentleman's time has expired. We now recognize the gentleman from Missouri, Mr. Luca Meyer, for 5 minutes.
Thank you, Mr. Chairman. Welcome. I guess I want to start where, what's the definition of insurance? I think it is the company accepting the risk to pay the losses that are incurred as a result of an automobile accident. Is that a fair explanation of what insurance is and the risk that you're taking? And so, Ms. Collins, you made the comment that the company's rate for risk, and that and I think 2 or 3 of you already said that the rates the rate factors are actuarially sound, so they can't go out, and there are laws in place that prohibit discrimination for certain things. So after that, we get to the point where, okay, how do we charge for the risk? Now, in flood insurance, we have one risk, one rate. If you have a $50,000 house, you pay $750. If you have a $250,000 house, you pay $750. Mr. Heller, you think that's fair?
The one rate for flood insurance, I don't think that's exactly how it works, because it's relative to where you are vis-a-vis the flood map.
It's pretty well one rate. We do not discriminate between the size of the risk. Do you think having one rate across the board is fair? That's my question.
I think that one rate would be an acceptable way to go if we're trying to create the biggest pool to bring people in. I think it's better to.
In other words, if you have a $250,000 house, you rather pay more for you rather pay less for your insurance than me, who have to subsidize your rate. Is that what you're saying?
No, I guess I'm not following your question, because there are different rates depending on what you're.
No, okay. Let's
insuring in the
throw out since you're not getting a rate. Okay, if you want to have one rate for everything.
Oh, I see.
Okay, so. We're taking car insurance, and everybody pays the same rate, period, across the board. Is that fair?
Yeah. If it were, that would not be the case. No, it would not be fair.
So in other words, if my son, he's a lot older than 19, but say he's 19, he's got 2 DWIs and 2 wrecks, buys a new Corvette, you want to pay the same rate as he does?
No, I believe that his risk would be higher.
Okay, so you agree that there are rating factors that should be an important part of this discussion.
That's absolutely right.
Okay, so where do we go with the rating factors? We have laws that say certain ones are legal, certain ones are not. Mr. Poe is concerned about some of the rating factors because his company is getting beat by Geico and Progressive because they decided to find different rating factors that they could use to be able to frame their rates differently. So in a free market society, if I like Snickers more than anybody else, and the insurance companies decide they want to go out here and figure out if people who eat Snickers candy bars are more or less likely to have a wreck, you think that's a good rating factor, if they want to take the risk on whether that is right or not?
Sir, the government,
yes to the question, yes
government
or no.
doesn't require people to buy Snickers. They do require people to buy auto insurance. It's a different market.
Mr. Heller, they require them only to buy liability on uninsured motorists, which is for somebody else, not for you, okay?
And yet they discriminate based on their
Would you want to be
factors.
hit by an uninsured motorist and suffer the loss for lots and lots of health issues and not have insurance to pay for that? Not have somebody reimburse you for your car that's been damaged if you got a brand new Cadillac? Is that fair? Yes or no?
That is not fair, and that's why we want to bring more people into the market so they're not
the
uninsured.
states have mandated that you have least liability insurance. Now, if you have full coverage, that's required by your lien holder, who, guess what? They want to be able to pay for that car if it has a wreck, right? So don't go there now and say, well, you're required to do this. You're not required to have full coverage unless you want it on your own car, unless the lien holder is there.
And sir,
That's fair,
all of
right?
the rate quotes that I gave are for liability-only coverage. We discriminate on liability for credit. You use your credit score just for the liability
I'm not there
policy.
yet. I'm talking about different criteria, and we're going to get there. Just a second.
Let's only talk about liability only, the one that you're required to buy. I think
we're talking
fair.
about different rating factors here. Yeah. My comment and question to you is, if I, as a business in the free market, want to decide if anybody who eats Snickers bars gets a discount because I think they're going to be more because of the sugar high they're on, they'll be able to react more quickly. Therefore, I think they're going to be a better risk. Is that okay for me to do that?
Not in the auto insurance market, because there's no justification for that.
If I can actually show that, these ladies over here said I can actually show that. Is that fair?
No, I don't think that would be fair.
You don't believe in actuarially having sound rates?
I think that what we need to do is we need to focus our rates on a product that we require people to buy.
No, you're missing the whole point. You're going off on another tangent, sir. I got the microphone. I'm sorry. I get my question. Okay. Ms. Collins, do you think I'm going down the right road here?
Yes, Congressman, I think it makes perfect sense. If you believe that rate should match risk, then it makes no sense
Is it in a
to
free market
dismiss.
society, is it okay for the company who decides they want to slice the bread thinner, if they come out with a different way to look at this that's within the law, and they want to decide if I can eat a Snickers bar and I'm more astute behind the wheel, I can be a better driver, is it okay for them to give me a discount and let somebody else have to pay more?
So,
Is that fair?
So long as factors are actuarially sound and
you
not
approve,
violation
and
of law,
they can actually show that I'm a better driver because of that?
we would support that, yes.
Thank you very much. I yield back.
Time has expired. I now go to the gentleman from Ohio, Mr. Davidson, for 5 minutes.
I thank the chairman. I thank the witnesses for coming and hoping to learn more for the good of the American people and the preservation of a very sound state-based automobile insurance market. Here we are yet again visiting an issue that this committee held a hearing on last year, and multiple bills and amendments have failed since then. When we discussed this topic last year, Congresswoman Beatty from Ohio put it well. She said, "This seems like a Michigan problem to me. Why should we use Michigan with a deeply flawed system as evidence that the federal government needs to usurp state laws and change how insurance rates are calculated?" I agree with her. Auto insurance costs an Ohio driver on average just $952 a year compared to $2,484 a year in Michigan. Better yet, auto insurance costs $1,277 a year on average in Cleveland, whereas it's $5,414 a year in Detroit. Now, these two cities have similar demographics, and these figures aren't mine. They're figures that Josh Rivera from the University of Michigan gathered and wrote about. I would like to enter his report into the record.
So ordered.
Thank the chairman. So the conclusion I'm supposed to draw from the dialogue here, or from some of my colleagues, is that to use credit scoring data by auto insurers amounts to some sort of racist or misogynistic conspiracy by the auto industry in response for higher auto insurance rates in Michigan. Why not Cleveland? Is there no one with a low credit score in Cleveland? Just Detroit? They got low credit scores in Detroit, and nobody in Cleveland has low credit scores? No racial minorities in Cleveland? There's no men and women differences in Cleveland than Detroit? This makes no sense to disrupt the system based off of the arguments. I would like to flesh out Congresswoman Tlaib's argument. We keep on discussing driving history only for privacy, or for pricing. There are a lot of folks who believe that minorities are more likely to be pulled over, ticketed, or arrested. Does that factor in? There are a host of factors that could explain some of these differences, and the question is, can insurance companies take into account actuarially sound data in their pricing models? So, Ms. Collins, what's the right way to factor these considerations in under actuarial standards and the bounds of the law?
Thank you, Congressman. So insurance companies look at a variety of factors to try to identify risk as closely as they can with the cost that would be incurred. And the ability for them to be able to do that is what keeps the market functioning. And the issues associated in Michigan have really very little to do with that process, as we noted earlier, and the medical costs associated in that system. So to directly answer your question, the impact of not being able to match that rate to that risk would cause uncertainty for insurance companies, and that would lead to a direct rise in costs.
Thank you for the explanation and further clarification that, frankly, my colleague from Michigan is trying to deal with state law by imposing a federal standard that could make Ohio as bad as Michigan, frankly. Instead, perhaps we could consider how the state legislature of Michigan could change the liabilities that insurers could price, that individuals could have in the market in Michigan. So that would be in the State House in Michigan, not here in Congress in Washington, D.C. My colleague would argue that we should do away with other factors and just use driving history. But if it's true, then how do we price in factors like liability in states, like state law? So we should be able to use sound practices, and we should be able to do it based on the law of the jurisdiction where the insurance coverage is being priced. It seems to me that when my colleagues are actually wanting a same price regardless of risk. They want to socialize the entire risk pool so that everyone's treated the same. However, risk-based pricing is a very basic lending principle, and publishing insurers' proprietary underwriting data will crush competition within the auto insurance industry. Only those who haven't spent time in the business, haven't developed their own intellectual property, would suggest doing away with it. I yield.
The gentleman yields back. We now recognize the gentleman from North Carolina, Mr. Budd, for 5 minutes.
Thank you for the time, Mr. Chairman. Also, thank you for the time in your district at some very nice barbecue restaurants. So look forward to having you in North Carolina and trying some Davidson County, Lexington-style barbecue.
Thank you.
So I also want to thank the witnesses for being here today. You know, I've spoken on one of these two bills that we're considering multiple times, and it's clear there isn't support in this committee for Congress to pull credit scoring data out of auto insurance underwriting. So as I've mentioned in the past, auto insurance costs about $85 a month on average that's in North Carolina. So that's the fourth lowest rate in the country. As we say in my district and probably elsewhere, if it ain't broke, don't fix it. So that said, the Fair Study Act is new, and I've done my due diligence. While, you know, you call it a study bill, it's anything but, and it's certainly not fair, so quite a misnomer here. Now, compliance costs aside, the bill directs the Federal Insurance Office to publish all of the proprietary information that it collects from auto insurers on an annual basis. The bill would destroy the foundation of competition in the insurance auto market. Now, everybody who's seen a football game and they've seen, or just anything on TV, have seen 15 insurance ads for auto insurance, and they inherently know that it's a competitive market with just lots of options for consumers. So luckily, there's no way to quantify that. The Department of Justice, which is responsible for enforcing antitrust laws, uses something called the Hirshman Index. Now, I've got a couple of business degrees from pretty good schools, and I had never heard of that. But I've seen it recently with some bank mergers, and now I see it related to this. So when the score gets to 2,500 or above, the index signals market consolidation that's actually harmful to consumers. So it's a helpful index. But the Hirshman Index for the property and casualty insurance industry was, remember now, 2,500 is harmful, but for the auto insurance industry, it's 302, and that was in 2018, so very low. And that's down from 346, also another low number in 1998. So it's gotten even better in 20 years. So Ms. Collins, can you explain for the committee the actual impact of the Fair Study Act if it were enacted? If the FIO published proprietary underwriting information from every participating auto insurer, what kind of pressure would it create for consumers?
Thank you, Congressman. So if proprietary information were to be made public, I believe that it would be hugely detrimental to consumers. As I noted at the outset, consumers are benefited by a highly competitive market, which the auto insurance industry is, in that they compete against each other to most accurately match rate to risk, and that benefits consumers both in their choice in products and the level of protection that they feel that they need, and serves to keep prices as low as possible. And so removing the ability of insurance companies to compete against each other to try to find the most effective ways to match rate to risk would serve to take away those benefits to the consumers.
Thank you for that. Now, my friends across the aisle claim that they want to stop too-big-to-fail financial institutions from forming or market monopolies taking hold, yet here's an example of a proposal that would kill competition and is one of the most competitive markets in the country. So Economics 101, the competition brings down prices for consumers, we all know that. Which is what I thought was the original goal of these bills. But the irony is that in these bills would actually hurt instead of help the policyholders. So by eliminating and studying ways to reduce a vast amount of factors used in underwriting, things which help these companies become more competitive and better for consumers, including making proprietary underwriting information publicly available, what you are actually doing is raising rates for consumers that currently shop for insurance, again, in this very competitive market. So question, if insurance would have to price risk based on guesswork, it is an obvious conclusion that the least risky drivers will have to subsidize the riskiest drivers. Ms. Collins, how would you respond to this?
Yes, Congressman, we would agree. By making insurance companies guess at what their exposure would be in order to remain solvent, they would necessarily have to increase rates just to meet their statutory obligation to their policyholders. So we totally agree with that sentiment.
Thereby hurting consumers.
Absolutely.
Thank you for your time.
The gentleman yields back. Now we go to the gentleman from Wisconsin, Mr. Style, for 5 minutes.
Thank you very much, Chairman. Thank you for holding today's hearing, and thank you to our witnesses for being here. Can I just start off, just get a show of hands if you believe that 9 non-driving related factors are predictive of risk? 3 out of 5, maybe?
There are probably some that have some value, but but the ones that we've spoken about today, I do not believe they're predictive of risk.
Very good. I appreciate that insight. Ms. Collins, I'd like to ask you, if we look at drivers' actual records, driving violations, amount of severity, and then you start to look at, is there other factors that an auto insurance might need to account for in the underwriting to cover operating costs, such as the regulatory cost of providing insurance in a jurisdiction, the severity of auto accidents and the injuries they cause, the prevalence of auto theft, the likelihood of filing an auto claim, the probability of policyholders defaulting on their premiums or any debt owed as a result of an accident, or the rate of uninsured motorists nevertheless driving in any given state. And since insurance companies have a solvency obligation to operate in a safe and sound manner, should companies be prohibited by federal law from including any of those pricing inputs or other pricing inputs that you're looking at into their underwriting models?
Thank you, Congressman. Absolutely not. They should not be prevented from doing that. The objective of underwriting, again, is to match most closely the premium and the rate to the risk that is represented. And the more tools that are actuarially sound and on point to get closer to that ideal, the more successful that insurance company is going to be in getting the right product to the right consumer's risk and be able to write broader risks for more consumers.
Thank you. And I think it's worth pointing out the challenges of when we socialize risk. And so all things being equal, with the average consumer's rates increase, if companies can no longer use predictive and approved factors, in particular in this instance we're talking about credit history.
Yes, Congressman. So removing the innovation and the trend towards finding new ways to identify and measure risk would take us backwards in the United States to a rather crude version of underwriting, and it would harm consumers in that the insurance company would have to guess, again, to use the other congressman's word, at what the risk might be, and therefore the lower risk drivers would necessarily be subsidizing the higher risk drivers in order to create that money for the pool to ensure that the insurance company could meet their obligation to their policyholders.
And as we talk today, and we hear some of my colleagues discuss involving the federal government and what has traditionally been a state-regulated agency, could you provide a little color and describe the process by which companies identify and evaluate risk factors? And in particular, can you highlight the role that state regulators are playing in permitting the use of specific rating factors?
So insurance companies use a multitude of risks. Not all insurance companies use all factors. As we've noted, the actuarial science shows that it is most successful when a combination of factors is in play. And this is important in the context of state regulation because the state regulators review how insurance companies combine those factors as well as the individual factors themselves to ensure that nothing is unfairly discriminatory and that rates are not excessive or inadequate.
So state insurance regulators are analyzing what constitutes unfair discrimination and what's prohibited at the state law level.
Absolutely, and they do so robustly.
I appreciate your testimony here today, and I yield back.
The gentleman yields back. At this time, the gentleman from California, Mr. Sherman, who is also the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
Mr. Chairman, I've been absent from this room because we had the briefing on the coronavirus by our Vice President. I am now totally reassured, maybe, and look forward to hearing from our witnesses. When I was 16, I was told 16-year-olds are bad drivers. Ms. Collins, is there, of course, 16-year-olds, when they first get their license, they don't have bad driving records. Do most insurance companies charge you more when you're 16 than when you're 26? And how, is there a real correlation between being a new driver with a spotless record and not being a good risk for the insurance company?
Yes,
microphone,
Congressman.
please.
Thank you very much for the question. Yes, there is actuarial science to show that less experienced drivers and younger drivers do pose a higher risk of loss, and that has been studied a multitude of times. And it's also showed, there was a NHTSA study that I've seen, that there are additional factors associated with age. For example, the incidence of texting while driving tends to diminish as a driver becomes more experienced and older as well.
Is it a matter of driving experience? Some people get their license when they're 16. Some may first get their license when they're 26. Do most companies look at age or number of years driving or number of miles driven? Kids at my high school drove a whole lot of miles. My wife's high school, even if you had your license, heck, you took the subway. Is it inexperience in terms of years holding the license, inexperience in having the numbers of miles driven, or just age?
I believe that insurance companies use a multitude of those factors to form a full picture of risk, but I would defer to Superintendent Dwyer to elaborate.
And while we do that, I'll go to the other end of the age spectrum. When my mother was 89, she still had her driver's license. I wouldn't let my kids drive with her. Ultimately, I persuaded her not to drive at all. She hadn't had an accident in at least a decade because she only drove 12 miles a month. Trust me, those were miles you didn't want to be in her car. So is it legitimate, Ms. Dwyer, for them to look at either young or old age in determining the level of risk?
When insurance companies look at any of those factors and file them with their rating plan, they have to provide the actuarial basis. So you can't just guess. You can't just guess.
They have to show you statistics. What level of correlation or regression analysis? Because some things correlate a little bit and some things are 1-to-1. Is there any level of certainty or correlation that's necessary?
So I have an actuary look at every rate filing for automobile insurance filed in my state. I'm not an actuary, but so I'm not absolutely sure on that. But I make sure that my actuary is satisfied with the level of correlation. So it has to be something significant, not a very vague correlation. It has to be something significant.
Is there any state that prohibits looking at age or experience rather than actual tickets and accidents of that individual driver?
I don't believe so, but we could.
So as far as you know, every state would allow, Mr. Heller?
Thank you, Mr. Chairman, and I also should mention I'm also a constituent of yours, so happy to see you here. I believe that while states don't prohibit that, there are several companies now, for example, who won't even ask how many miles you're driving, so they're not looking at some of the real legitimate factors that do relate, that we can show the data. Instead, they turn to these other factors that we've talked about all day, like your credit score and your job.
I'm with the California Auto Club,
as you know,
they hound me 3 or 4 times before I finally am able to remember how many miles I've got on each odometer on each coast. And then they give me a discount if I get the document in on time. Obviously, number of miles driven is important. Superintendent Dwyer, are there any states that require companies to look at such a relevant factor as how many miles do you drive every year?
I don't believe so. However, we have that in most filings. Disclosure by the consumer is not necessarily the best way to determine that, from what I've heard from companies. They're getting this information through big data occasionally. But they are
No, trust me, the Chinese don't know how many miles I drive each of my cars yet, as far as I know. But if we just look at whether you've had an accident recently, we're missing out on the fact that my high school friends had terrible attitudes toward driving. My mother had some problems, and I only drive a few miles here in Washington.
Mr. Sherman, if I could clarify, though, it should be noted that
I'll ask the chairman if I have the time.
Mr. Chairman, if I could
It's
just
up to him.
clarify one point that was made by the superintendent very briefly. Just that California does require that miles are used in rating. That's all. California law does require that.
That's a good thing.
The gentleman yields back. At this time, I am going to take 2 minutes to close, and in that 2 minutes, I'm going to yield to my friend from Michigan, since this subject has generated quite a bit of discussion. And so it's her bills. I yield to the gentlewoman from Michigan for 2 minutes for closing remarks.
Thank you, Mr. Chairman. Look, I understand that there's a whole formula within the industry, but I feel like the formula right now has led towards discriminatory practices because the data and information out there is very clear, and I think it's very important for all of us. And I'll work with colleagues on the other side of the aisle to actually have the federal, insurance office to look at it, whether or not there is disparate impact in this formula. It is the federal government's job, and I'm not trying to change state law. I'm trying to ensure there's people on the ground, people like my community, which is the third poorest in the country, is not being directly discriminated against based on these factors. And it's sincere. It's the fact that I have seen data that it is preventing them from owning their own homes because they're paying these high rates. But I also feel like it's very much discriminatory and dehumanizing to be asked about education level, to be asked about marital status, and to see that somehow you're now going to be treated differently solely based on your credit score. For me, having a drinking under the influence violation is a huge risk, but that person is going to pay less than the person that has not a great credit score. I mean, Florida, just the data in Florida is unbelievable to see that somebody with poor credit is paying $3,826, somebody with better credit is paying $1,400. What is going on here? And these are proxies, and we are not going to allow, and Mr. Heller, you all know, we have to prohibit the collection of racial data by insurers, and we do that. But these are now being used as proxies. Prove me wrong that they're not by allowing a disparate impact study to actually happen. What are you afraid of showing? Prove us wrong by allowing the Federal Insurance Office to investigate this and to look at this. Thank you so much, Mr. Chairman, for this hearing. I know many of my residents at home really do appreciate this.
The gentlewoman yields back, and I recognize the gentleman.
Thank you, and I'll be fairly brief. I'll conclude as I started. Thank you to the chairman for offering this hearing. Everyone in this room is opposed to discrimination. There was great testimony by Ms. Dwyer about what our insurance commissioners at the state levels are doing to make sure we stop discrimination based on factors that they shouldn't use to discriminate. But we also need to figure out how to create an insurance system that is priced fairly for everyone. And generally, under McCarran-Ferguson, I trust our state-based regulators to do that job. I think there's been some really good studies that have been done, including the Stanford University study that shows if you move away from factors and only do driving factors, you actually make the situation worse for African Americans and other folks who face some discrimination in the way that they're pulled over and the way they're ticketed. So, there may be no perfect system, there may be no perfect underwriting factors, but, and I'm not saying that there isn't a study we couldn't work on, but the study as it's worded in this bill that we talked about today has a lot of conclusions that aren't based on any facts. And I wouldn't want to support a study that already has conclusions in it. That's not fair. A study should be a study that looks at things fairly and then makes conclusions based on what's observed, not conclusions based on when you authorize the study. So while I'd be willing to work on that with the gentleman or the gentlelady from Michigan, the chairman or the gentlelady from Michigan, I think we'd have to do that in an appropriate way that doesn't start with conclusions. It might end with conclusions, but it shouldn't start with conclusions, and that's my concern about the study that was proposed today. I think there's been a lot of great testimony by all the witnesses. Again, I want to thank all the witnesses for your perspectives. And while I trust our state-based regulators, I'm not saying there's not a federal role. I would want to make sure if there was a federal role, it was done in a thoughtful way without conclusions up front. I yield back, Mr. Chairman.
Gentlemen, yields back, and I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able, and without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is adjourned.